So, hello. In this webinar, we are going to learn accounting standard, okay, with the help of Gemini 2.5 Flash Pro. Now, hey Gemini, help me with learning the concept of advanced accounting for CA intermediate examination to other thing for 2000. Let's again. Here, hey, hey Gemini, help me. Hey Gemini, help me with accounting standard 2, valuation of inventory. Hey Gemini, help me with accounting standard 2, valuation of inventory. So, no. Hello. Hey Gemini. Let's learn advanced accounting for CA intermediate examination, say 2025. Okay. So the first prompt that we need to understand the syllabus and weightage and marking and everything about advanced accounting. First of all, let it go. Let's directly jump into our first chapter, that is Introduction to Accounting Standard. Okay, intro to, let's learn. Let's learn first chapter, Advanced Accounting. First chapter of Advanced Accounting, that is Intro to Accounting Standard. Okay, that's an excellent starting point. Introduced to Accounting Standard is a foundation to advanced accounting and sets the stage for understanding all other accounting standards. Let's dive into it. This introductory chapter typically covers meaning and objectives of accounting standard, benefits of accounting standard, limitation of accounting standard, process of formulation of accounting standard in India by ASB and ICAI, scope and applicability of accounting standard, and convergence to IFRS and Indian accounting standard. Ind AS. Let's break down each of these points. Chapter 1, Introduction to Accounting Standards. First, meaning. In meaning, we will see the accounting standards are written policy documents issued by expert accounting bodies or government authorities or other regulatory bodies covering the aspect of recognition, measurement, presentation, and disclosure of accounting transactions and events in the financial statements. Think of them as a set of rules and guidelines or principles that ensure consistency, comparability, reliability, and transparency in financial reporting. They prescribe how specific types of transaction and events should be accounted or presented accounted for and presented in the financial statement. Objectives. The primary objectives of accounting standards are to bring uniformity, improve comparability, enhance reliability, ensure transparency, aid decision making, then harmonize accounting policies. First, bring uniformity. To bring uniformity in accounting practices by reducing, if not eliminating, diverse accounting practices. This means different companies, when applying the same standard, will account for similar transactions in a similar manner. Improve comparability to facilitate interfirm between different companies and intra-firm within the same company over different periods, comparisons of financial statement, then enhance reliability. To enhance the reliability of financial statement by providing a common framework for preparing and presenting financial information. Reliable financial statements build trust among users, ensure transparency. To ensure transparency in financial reporting by requiring adequate disclosures, users should be able to understand the financial position and performance clearly. So, accounting standards ensures transparency, aid decision making to assist various stakeholders like investor, creditors, management, regulators in making informed, informed economic decisions by providing relevant and reliable financial information. Harmonize accounting policies to harmonize the diverse accounting policies and practices followed by different enterprises, thereby narrowing down the areas of differences in accounting. Benefit of accounting standards. Implementing accounting standards offer several significant benefits. First one is improve comparability and uniformity, enhance reliability and credibility, increase transparency and disclosure, then prevention of manipulation, then facilitates auditing, investor protection, then legal compliance. Improve comparability and uniformity, as mentioned above, this is a major benefit, making financial statement more meaningful. Enhance reliability and credibility. Users have more faith in financial statement prepared in accordance with established standards. Increase transparency and disclosure. Standards mandate certain disclosure, preventing companies from hiding crucial information. The prevention of manipulation. By prescribing specific treatment standard, reduce the scope of manipulation and creative accounting of financial results by management. Then financial facilitates auditing. Auditors find it easier to audit financial statement prepared under a common set of standards, leading to more efficient and effective audit. Investor protection by providing standardized and reliable information, standards help investors make better decisions, thus protecting their interest. Legal compliance. In many countries, adherence to accounting standards is a legal requirement. Limitation of accounting standard. While highly beneficial accounting standards also have certain limitations, rigidity and lack of flexibility. Standards can be rigid and may not always accommodate specific circumstances or unique industry practices. They might reduce flexibility in preparing financial statement. Choice between alternative treatments. In some cases, standards might allow for alternate accounting treatments for the same transaction. For example, different differentiation method, inventory evaluation methods, This can still affect comparability to some extent, although it's minimized. Cost versus benefit. Implementing and complying with standards can be costly, especially for smaller entities, and the benefit derived might have not have always justify the cost. Resistance to change. New standards or amendments to existing ones might face resistance from companies due to the effort and cost involved in adapting. Okay, adapting. In this historical nature, accounting standards are generally based on historical cost, which may not reflect the current fair value of the assets and liabilities, especially in inflationary environments. Requires professional judgment. Despite standards and professional judgment is still required in applying them, which can lead to variation in practice. Evolutionary nature. Accounting standards are dynamic and continuously evolving. This means companies need to constantly update their system and practices, which can be challenging. Then, process of formulation of accounting standard in India, ESB and ICAI. In India, accounting standards, referred as AES or existing standards, are primarily formulated by Accounting Standard Board, that is ASB of the Institute of Chartered Accountants of India, ICAI. Here is a simplified overview of the process. First, identification of area. The ASB identifies an area where an accounting standard is needed, considering the economic environment, legal requirements, and international accounting practices. Constitution of study group. Once the areas where we need to focus have been identified, the second stage or second process is the constitution of study group. A study group is constituted by ASB to prepare preliminary draft of the proposed standard. This group usually comprises experts from various fields like ICAI members, industry professionals, academics, and regulators. Preparation of preliminary draft. Then once we have constituted a study group, then that study group need to prepare a preliminary draft. The study group prepares the preliminary draft covering the scope, definition, recognition, measurement, presentation, and disclosure requirement. Scope, definition, recognition, measurement, presentation, and disclosure requirements. Review by ASB. Once the preliminary draft has been prepared, the ASB reviewed it. The preliminary draft is reviewed by ASB. Then exposure draft. The ASB issues the draft as an exposure draft for public comments. This ED, that is exposure draft, is circulated widely to the professional bodies, industry associations like FICCI, CII, regulators like SEBI, RBI, MCA, and general public. In public comments, interested parties provide their comments and suggestion on the exposure draft. This is crucial step for stakeholders' involvement. After the public comments, a review of comments. The ASB reviews all comments received and makes necessary revision to the draft. Then final draft approval. The revised draft is then submitted to the Council of ICAI for approval. Issuance by ICAI. Once approved by ICAI Council, the accounting standard is issued by the ICAI. Notification by MCA. Mandatory application. For the standard to become a mandatory for companies, they need to be notified by the Ministry of Corporate Affairs, that is MCA, under the Companies Act 2013. The, the MCA consults with the National Financial Reporting Authority, that is NAFA, before notifying standards. NFRA, formerly NACAS, National Advisory Committee on Accounting Standard, plays an advisory role to the MCA. Key bodies: ICAI, ASB, MCA, NFRA, NAFA. Scope and applicability of accounting standards. So accounting standards are applicable to various entities based on their size and nature of operations. ICAI classifies entities into different levels for the purpose of applicability of AS generally based on turnover, borrowing, and paid-up capital. Level of entities as per ICAI. ICAI generally categorize enterprises into three levels: level 1, level 2, level 3. Uh, Basically, ICAI categorize enterprises into two types. One is corporate and non-corporate. And non-corporate entities further classified or categorized into C levels: level 1, level 2, level 3. In level 1 entities, these are large entity, typically uh, listed organization like listed companies, bank, financial institutions, insurance companies, and those with high turnover borrowing. These entities are required to comply with the accounting standards in their entirety. So uh, this Gemini may be not properly given the categorization of entities for the scope and application of accounting standards. So we will ask it to explain, elaborate it, the levels, uh, applicability of standards. So we will see that later on. First, we will see convergence to IFRS and Indian accounting standards. This is a crucial concept in the Indian accounting landscape. IFRS, that is International Financial Reporting Standards, these are global accounting standards, standard issued by the International Accounting Standard Board, that is IASB. They are designed to be a common global language for business affairs so that the company accounts are understandable and comparable across national borders. Need for convergence. With a globalization, Indian companies operating internationally needed financial statement comparable to their global counterparts. Differences between Indian AS and IFRS created issues in cross-border investment and understanding. So convergence aims to align Indian accounting practices with global best practices. What is convergence? Convergence does not mean blindly adopting IFRS. It means developing accounting standards that are largely in line with IFRS, but with a certain carve-outs differences to suit the Indian economic environment and legal framework. Indian accounting standards in AS, these are the IFRS converged standards notified by the Ministry of Corporate Affairs, that is MCA, under Companies Act 2013. They are largely based on IFRS but contain specific modification or carve-outs for India. Phase implementation of INDES. INDES has been implemented in India in a phased manner for various categories of companies, such that listed companies, large unlisted companies, banks, and BFCs, and the applicability depends on factors like listing status, net worth, and type of entity. Your focus for CA Inter Advanced Accounting, September 2025. While this is introductory chapter discusses Indias and IFRS, the core of your CA Inter Advanced syllabus focuses on existing accounting standards issued by ICAI and notified by MCA, not Indias. So you will learn the Indias in your CA final studies, however, understanding why Indias came into being. Convergence with IFRS is a part of this introductory chapter and provide content. How to find this chapter? How to study this chapter? Read thoroughly, go through the ICI study material for the chapter completely. So we will go through the complete ICI study material chapter, first chapter, that is Introduction to Accounting Standard. Then we will understand the concept, ensure you grasp the meaning and objective and benefits and limitation of the AS. Then process flow, understand the formulation of accounting standards in India by involvement of ICAI, ASB, MCA, NFRA, roles in the the formulation of AS accounting standards. Then applicability, familiarize yourself with the concept of levels of entities and why it's important. The, you won't need to memorize the exact threshold for the exam unless specifically asked in a theoretical question. Indias versus AS clearly distinguish between the two for your exam perspective, and your syllabus is primarily on accounting standards. In practice short questions, this chapter can't have direct theoretical question in the exam, so can have direct theoretical questions in exams. So be prepared to write descriptive answers. So this chapter sets a strong foundation for your journey into the specific accounting standards. Then let me know if you would like to delve deeper into the specific aspect of this introduction. If you are ready to move on a specific AS like AS1, AS3, then we will start. Okay, first we will say applicability of companies governed by Companies Act 2013. They have given us the applicability of for India's and general criteria for mandatory India's applicability. So they have given us about India's. Okay, turnover borrowing, yeah, non-company entities. See, so now applicability to companies governed by Companies Act 2013. For companies, the primary set of standards now are the Indian accounting standards, Indias, which are converged with IFRS. However, the existing accounting standard, that is AS, still apply to significant number of companies that do not fall under the India's applicability criteria. So if we cover the India's applicability for the company, and other than those companies which don't apply and needed to be comply with India's, those are the companies who require accounting standards. Okay, so for India's has been implemented in a phased manner. Once a company becomes applicable for India's, it must follow India's for both its standalone and consolidated financial statements. General criteria for mandatory India's applicability. First one, listed companies. So all companies whose equity or debt securities are listed or are in the process of being listed on the stock exchange in India or outside India needed to follow India's. Needed to follow India's. So, in unlisted companies based on net worth, we consider net worth, and based on that net worth, we decide applicability of India's. Unlisted companies having a net worth of rupees 250 crore or more, at least 250 crore need to be mm, reaching net worth to be compliant with India's. So, unlisted company having net worth of 250 crore or more need to be compliant with India's. Note on net worth. Net worth is calculated as Section 2, Clause 57 of Companies Act 2013, paid up share capital plus reserve created out of profits accumulated and minus accumulated losses, then minus deferred expenditure. It is usually checked as on specific date, for example, March 31st, 2025, something depending on the phase. Okay, March 31, 2014 or March 31, 2015, depending on the phase. Okay. Other specific entities, banks, NBFCs, insurance companies, these have their own phase implementation roadmap for India. Generally, based on their net worth, large banks and NBFCs are already under India's. Okay. Holding subsidiary Holding subsidiary or joint venture or associate companies. Once India's become applicable to any company, it automatically become applicable to its holding subsidiary, associate and joint venture companies, irrespective of their individual net worth or listing status. This ensure consistency within a group. Consequence: If a company falls consequences if a company falls under India's applicability criteria, it will not apply the traditional accounting standard. Instead, it will apply India's. Your CA inter exam context, while it's important to understand the India's applicability broadly, your CA intermediate advanced accounting Syllabus primarily focus on the traditional accounting standard to the AS, and the India's framework is largely covered at CA final level. So companies applying accounting standard, that is AS, these are companies that do not meet the criteria for mandatory India's applicability. They continue to prepare their financial statement based on accounting standard AS notified under Companies Accounting Standard Rules 2006 and subsequent amendments. Within the AS framework, the ICAI has historically classified companies into different levels. Companies into different like level 1, level 2, level 3 to provide certain exemption or relaxation to smaller entities from specific AS provisions, primarily related to disclosures. It's crucial to refer to the latest ICAI announcements on applicability of accounting standards for non-company entities, which typically details these levels and exemption and any MCA notification for companies. However, a general understanding of the historical classification is level 1 companies. These are generally large companies that are expected to comply with all accounting standards in their entirely without any exemption or relaxations. Listed companies, if not India's applicable, then companies in the process of listing, banks, financial institutions, insurance companies, and other commercial or industrial or business entities with very high turnover or borrowing, and the specific thresholds are revised by ICI, MCA periodically. Now, level two, there's a companies formerly small and medium companies, SMCs. These are entities that do not fall under level one, but meet certain medium-sized criteria based on turnover or borrowings. They generally get exemption from certain accounting standards, particularly those that primarily deal with extensive disclosures such as AS3, cash flow statement, is the cash flow statement is 24 days continuing operations, relaxations in disclosures for certain AS that are applicable, for example, reduced disclosure requirement in AS 19 leases, AS 20 earnings per share. Level 3, companies formerly small and medium companies, SMCs, these are entities that are smaller than level 2 companies. They typically receives more extensive and exemptions and relaxation than level two companies. The logic is that smaller entities may not have the resources or the need to comply with all detailed requirements of every accounting standards. So now, before this thing, we can get elaborated through study material only. Okay, we will start the first chapter, that is Introduction to Accounting Standard. Okay, so let me. Okay. Introduction to Accounting Standards. What are the learning outcomes? To understand the concept of accounting standard, grasp the objectives and benefits of accounting standards, learn the standard setting process. So we have to learn standard setting process. Then the objectives and benefits of accounting standards. Then understand the concept of accounting standard. Familiarize with the status of accounting standards in India. In India, what is the status of accounting standard? Then recognize the internationally accounting standard authorities, appreciate the emergence of international financial reporting standard as a global standard, differentiate between the convergence versus adoption, know the process of convergence of IFRS in India, understand the concept of India's, then understand the objectives and concept of carve-outs and carve-ins. Now we will see chapter overview over here. First, we will learn introduction and objectives and benefit of accounting standard. Then we will see accounting standard setting process. Then list of accounting standards. Once we have gone through list of accounting standard, then we will learn need for conversions to global standards. Then we will learn IFRS, that is International Financial Reporting Framework. Then we will see convergence of to IFRS in India. Then we'll understand the concept of India's. Then we will see carve outs and carve in, and the roadmap for India's implementation. Now let's see introduction. Generally accepted accounting principles. Generally accepted accounting principles, that is GAAP, refer to a common set of accepted accounting principle, standards, and procedures that business reporting entity must follow when it prepares and presents its financial statement. So what is meant by GAAP refers to a common set of accepted accounting principles, standards, and procedures that business reporting entity must follow when it prepares and presents its financial statements. GAAP is a combination of authoritative standard set by policy boards and the commonly accepted ways of recording and reporting accounting information. At international level, such authoritative standards are known as International Financial Reporting Standards, in short IFRS, at many places, and in India we have authoritative standards named as Accounting Standards AS, and Indian Accounting Standards. Here we will see accounting standards are written policy document. And accounting standards are written policy documents issued by government with support of other regulatory bodies. For example, Ministry of Corporate Affairs issuing accounting standard for corporates in consultation with National Financial Reporting Authority (NFRA), covering the following aspect of accounting transactions and events in the financial statement: those are recognition, measurement, presentation, and disclosure. Now, the ostensible purpose of standard setting bodies is to promote the dissemination of timely and useful financial information to investors and certain other stakeholders having an interest in the company's economic performance. Accounting standards reduce the accounting alternatives in the preparation of financial statement within the bounds of rationality, thereby ensuring comparability of financial statements of different enterprises. Accounting standards deal with the following aspects. First one is recognition, second one is measurement, third one is presentation, and fourth one is disclosure. Recognition of what? Events and transaction in the financial statement. Measurement of this transaction and event. Preparation of this transaction and events in the financial statement in a manner that is meaningful and understandable to the reader. Then disclosure relating to this transaction and events to enable the public at large and the stakeholders, the potential investors in particular, to get an insight into what this financial statement are trying to reflect and thereby facilitating them to take prudent and informed business decisions. Let's say, now we'll see accounting standard deals with these aspects of accounting events. These are recognition of events and transactions, measurement of transaction and event, then presentation of transaction and event, and disclosure requirement. Okay. Now we will see the benefits of accounting standard. Accounting standard. First, standardization of alternative accounting treatments. Accounting standard reduce or eliminate to a reasonable extent any confusing variation in the accounting treatment and presentation of economic events while preparing financial statement. So standard reduce and eliminate to a reasonable extent and confusing variation. So it comes with uniformity in the accounting treatment and presentation of economic events while preparing financial statement. The standard policy are intended to reflect a consensus on accounting policies to be used in different identified areas such as inventory valuation, capitalization of cost, depreciation and amortization, etc. Since it is not possible to prescribe a single set of policies for any specific accounting area that would be appropriate for all enterprises, it is not enough to comply with the standards and state that they have been followed. In other words, one must also disclose the accounting policies used in the preparation of financial statement. For example, ES1 that states disclosure of accounting policies given in accounting pronouncements. For example, an enterprise should disclose which of the permitted cost formula like FIFO, weighted average, etc., has actually been used for assigning inventory cost. Okay. Then the second benefit is requirement for additional disclosure. There are certain areas where information is not statutorily required to be disclosed. However, accounting standards may call for appropriate disclosure of accounting policies follow and other required information in the financial statement, which would be helpful for to understand the accounting treatment done for various items in the financial statements. The third benefit is comparability of financial statement. In addition to improving credibility of accounting data, standardization of accounting procedures improves comparability of financial statement both intra-enterprise and inter-enterprise. Such comparisons are very effective and most widely used tools for assessment of enterprise financial health and performance by users of financial statement for taking economic decisions. For example, whether or not to invest or whether or not to lend, and so on. The intra-enterprise comparison involves the comparison of financial statements of same enterprise over a number of years. The intra-enterprise comparison is possible if the enterprise uses same accounting policies every year in the drawing up its financial statements. The inter-enterprise comparison involves comparison of financial statement of different enterprise for same accounting period. Different enterprise for same accounting period. This is possible only when the comparable enterprises are similar, use similar accounting policies in preparation and presentation of financial statement, or in case the policies are slightly different, the same are disclosed in the financial statement. The disclosure of accounting policies allows the user to make appropriate adjustment while comparing the financial statement of comparable enterprises. So when we say the benefits of accounting standards, first is standardization of alternative accounting treatment, then requirements of additional disclosure, and then comparability of financial statement. Since accounting standards are principle-based, application of accounting standards becomes judgmental in case of complex business transactions. Accounting standards have to be read in line with the legal requirements such that in case of any conflict, statute would prevail over accounting standards. Another advantage of standardization is reduction the scope of creative accounting. The creative accounting refer to the twisting of accounting policies to produce financial statements favorable to a particular interest group. For example, it is possible to overstate profits and assets by capitalizing revenue expenditure or to understate them by writing off capital expenditure against revenue of current accounting period. Such practices can be curbed only by framing policies for capitalization, particularly for the borderline cases where it is possible to have divergent views. The accounting standards provide adequate guidance in this regard. Then we will see standard setting process. The Institute of Chartered Accountants of India, ICAI, being a premier accounting body in the country, took upon itself the leadership role by constituting the Accounting Standard Boards, that is ASB, in 1977. The ICAI has taken significant initiatives for the issuance of accounting standards to ensure that the standard setting process is fully consultative and transparent. The ASB considered the International Accounting Standards (IAS) and International Financial Reporting Standards (IFRS) while framing accounting standard ASS in India and tried to integrate them in the light of applicable laws, customs, uses, and business environment in the country. The composition of ASB includes representatives of industries, association of industries, namely ASO, SCSCHAM, CII, FICCI, regulators such as regulators, academicians, government department, etc. Although ASB is a body constituted by the Council of ICI, ASB is independent in the formulation of accounting standards. NAPRA recommend these standards to the MCA, and MCA has to spell out the accounting standards applicable for companies in India. The standard setting procedure of ASB can be briefly outlined as follows. Step 1, identification of area. Step 2, constitution of study groups. Identification of area. Identification of broad areas by ASB for formulation of AS. So first step is identification of area. So the broad area, identification of broad areas by ASB for formulation of accounting standard. Second is constitution of study group. Constitution of study groups by ASB to consider specific projects and to prepare preliminary drafts of the proposed accounting standards. The draft normally includes objectives and scope of the standard, then definitions of the terms used in the standard, then recognition and measurement principles wherever applicable, and presentation and disclosure requirements. Consideration of preliminary draft prepared by the study group of ASB and the revision, if any, of the draft on the basis of deliberations. Step 3, preparation of drafts and its circulation. Circulation of the draft of accounting standard after revision by ASB to the council of members of the ICAI specified outside the bodies such as MCA, SEBI, then CAG, CNAG, then Central Board of Direct Taxes, CBDT, then Standing Conference of Public Enterprises, Co, etc. for comments. Step 4 is ascertainment of views of different bodies draft. Meeting with the representatives of the specified outside bodies to ascertain their views on the drafts of the proposed accounting standards. Then we done finalization of exposure draft, that is ED, finalization of exposure draft of the proposed accounting standard and its issuance, inviting public comments. And then step 6 is the comments received on exposure draft. Consideration of comments received on the exposure draft and finalization of the draft accounting standard by the ASB for submission to the Council of the ICI for its consideration and approval for issuance. Then step 7 is the modification of draft. Consideration of the final draft of the proposed standard by the Council of the ICI. If found necessary, modification of the draft in consultation with the ASB is done. Then issued of AS. The accounting standard on the relevant subject for a non-corporate entity is issued by the ICI directly, and for corporate entities, the accounting standards are issued by the Ministry of Corporate Affairs in a consultation with NAPRA. Then standard setting process flowchart, identification of area, constitution of study group, then preparation of drafts and its circulation, then ascertainment of views of different bodies on draft, then finalization of exposure draft, then comments on received on exposure draft, then modification of the draft, and then issue of accounting standard. Earlier, ASB used to issue accounting standard interpretation, ESIs, which addresses the questions that arise in course of application of standards. These were therefore issued after issuance of the relevant standard. Authority of the ESI was same as that of ES to which it relates. However, after notification of accounting standards by the central government for the companies where the consensus portion of ESI was merged as an explanation to the relevant paragraph of the accounting standards, the Council of ICAI also decided to merge the consensus portion of ESI as an explanation to the relevant paragraph of ES issued by them. This initiative was taken by the Council of the ICI to harmonize both the set of standards so that ASS issued by the ICI for non-corporate and AS accounting standard notified by the MCA for corporates. It may be noted that as per Section 133 of the Companies Act 2013, the central government may prescribe the standards of accounting or any addendum thereto as recommended by ICI. ICI constituted under Section 3 of CA Act 1949 in consultation with and after examination of the recommendation made by NACA. How many accounting standards? The Institute of Chartered Accountants of India has so far issued 29 accounting standards. However, ES6, that is depreciation accounting, has been withdrawn on revision of ES10, property, plant, equipment, and ES8, that accounting for research and development, has been withdrawn consequent to the issuance of ES26, that is on intangible assets. Thus, effectively, there are 27 accounting standards at present. The accounting standards issued by Accounting Standard Board (ASB) established standards which have to be complied by the business entities so that the financial statements are prepared in accordance with GAAP, generally accepted accounting principles. In the recent times, there are various improvements and developments in the global accounting standards which have taken place. In India, India's have become mandatory for certain class of companies as per the MCA's roadmap as being the guidelines to prepare financial statement have to keep pace with these changes in global accounting scenario. Number of fundamental changes have been made in this area so as to be globally aligned as far as possible. Okay. The MCA-wide notification dated on 30th March 2016 announced companies accounting standards amendment rules 2016. These rules were superseded by the companies accounting standard rules 2021, which were notified by the MCA on 23rd June 2021. Various accounting standards such as AS2, AS4, AS10, AS13, AS14, AS21, AS21 have been revised to make them in line with the corresponding Indias to the extent possible. Now, the following is the list of accounting standards with their respective dates of applicability. The disclosure of accounting policies come to effect on 1st April 1993. The ES2 valuation of inventories revised come to the effect on 1st April 1999. Third one is ES3 cash flow statement on 1st April 2001. Then ES4 contingency and events occurring after the balance sheet day revised comes to the play on 1st April 1998. Then ES5 net profit or loss for the prior period items and changes in accounting policies come to the effect on 1st April 1996. 7. Construction contracts come to the effect on 1st April 2002. ES9 revenue recognition comes into the play on 1st April 1993. ES10 property plant equipment comes on 1st April 2016, whereas the ES11 the effects of changes in foreign exchange rates revised comes into play on 1st April 2004. ES12 that is accounting for government grants uh, comes into picture on 1st April 1994. ES30 that accounting for investment has been made applicable on 1st April 1995. Then accounting for amalgamations comes into the picture on 1st April 1995. Then ES15 that employees benefits comes into the role on 1st April 2006. ES16 borrowing cost comes into the picture on 1st April 2000. Then ES17 segment reporting comes into the effect on 1st April 2001. Then ES18 related party disclosures have been applicable from 1st April 2001 has been applicable. Then ES 19 leases uh, comes into the picture from 1st April 2001. Then on 1st April 2001, the ES 20 earning per share also have become applicable effective. Then ES 21 consolidated financial statements comes into the picture on 1st April 2001 only. Then years 22 accounting for taxes on income comes into the picture on 1st April 2006. Then years 23 accounting for investment in associates in as a consolidated financial statements comes into the play on 1st April 2002. Years 24 discontinuing operations comes into the picture on 1st April 2004. Years 25 interim financial reporting uh, comes into effect on 1st April 2022. In years 26, intangible assets comes into the picture on 1st April 2003, whereas the financial reporting of interest in joint ventures comes into the picture on 1st April 2002. Years 22 and 28, impairment of assets comes into the picture on 1st April 2008. 29, provision and contingent liabilities and contingent assets revised comes into the effect from 1st April 2004. Now, in the study material, accounting standards have not been discussed sequentially. Instead, the related accounting standards have been grouped and discussed in the ensuing chapters for ease of understanding. For example, the presentation and disclosure-based accounting standard, those are AS1, AS3, AS17, AS18, AS20, AS24, and AS25 have been grouped in one chapter. The chapter-wise grouping of the accounting standard has been discussed in the study material as follows. Presentation and disclosure-based accounting standards. AS1, disclosure of accounting policies. AS3, cash flow statements. AS17, segment reporting. AS18, related party disclosure. AS20, earning per share. AS24, discontinuing operation. AS25, interim financial reporting. Then chapter 5, that is asset-based accounting standards, in which AS2, valuation of inventory, AS10, PPE, property plant equipment, AS13, accounting for investment, AS16, borrowing cost, AS19, leases, AS26, intangible assets, AS28, impairment of assets. Then chapter 6, liabilities-based accounting standards, only two, AS15 and AS29. AS15, employee benefits, AS29, provisions, contingent liability, and contingent asset. Chapter 7, accounting standard based on items impacting financial statement. AS4, contingencies and events occurring after balance sheet date. Then AS5, net profit or loss for a period, prior period items and changes in accounting policies. AS11, the effects of changes in foreign exchange rate. AS22, accounting for taxes on income. Chapter 8, revenue based accounting standards. AS7, construction contracts. AS9, revenue recognitions. Chapter 9, other accounting standards. AS12, accounting for government grants. AS14, accounting for amalgamations, excluding intercompany holdings. Chapter 10, accounting standards for consolidated financial statements. AS21, consolidated financial statements of single subsidiaries, excluding problems involving acquisition of interest in subsidiary at different dates, cross-holding, disposal of subsidiary and foreign subsidiary. AS23, accounting for investment in associates in consolidated financial statement. AS27, financial reporting of interest in joint venture. Now, we will see status of accounting standards in India. It has already been mentioned that accounting standards are developed by ESB of the ICAI. The institute, not being a legislative body, can enforce compliance with its standards only by its members. Also, the standards cannot override laws and local regulations. The AS are nevertheless made mandatory from the date specified in respective standards and are generally applicable to all enterprises subject to certain exceptions and exemptions. The implication of mandatory status of of an AS depends on whether the statute governing the enterprise concerned requires compliance with the AFS. The Companies Act had earlier notified 28 accounting standards and mandate the corporate entities comply with the provisions stated therein. However, in 2016, the MCA withdrew AS6. Hence, there are now only 27 notified accounting standards as per Companies Accounting Standard Rules 2021. Now, need to convergence towards global standards. The last decade has witnessed a sea change in the global economic scenario. The emergence of transnational corporations in search of money not only for fueling growth but to sustain non-ongoing activities has necessitated raising of capital from all parts of the world, cutting across frontiers. A few key aspects which require the need of convergence are as under raising funds from international corporations, country. uh, Each country has its own set of rules and regulations for accounting and financial reporting. Therefore, when an enterprise decides to raise capital from the markets other than country in which it located, the rules and regulations of that other country will apply, and this in turn will require that enterprise is in a position to understand the differences between the rules governing financial reporting in the foreign country as compared to its own country of origin. Therefore, translation and reinstatement are of utmost importance in a world that is rapidly globalizing in all ways. Further, the accounting standards and principles need to be robust so that the larger society develops degree of confidence in the financial statements which are put forward by organizations. Second one is comparability of financial statements. International analysts and investors would like to compare financial statements based on similar accounting standards, and this has led to growing need for an internationally acceptable set of accounting standards for the cross-border filings. The harmonization of financial reporting around the world will help to raise confidence of investors and generally in the information they are using to make their informed economic decisions and assets their risk. Uniformity, comparability, and transparency, etc. A strong need was filled by the legislation to bring about the uniformity, rationalization, comparability, transparency, and adaptability in the financial statement, having a multiplicity of types of accounting standards around the world is against the public interest. If accounting for the same event and information procedure produces different reported numbers depending on the system of standards that are being used, then it is self-evident that the accounting will be increasingly discredited in the eyes of those using the numbers. It creates confusion, encourages error, and may facilitate fraud. The cure for this is to have a single set of global standards of the highest quality set in the interest of public. Global standards facilitate cross-border flow of money, global listing of different stock markets, and comparability of financial statement. Global investment. The convergence of financial reporting and accounting standard is valuable process that contributes to the free flow of global investment and achieves substantial benefit for all capital market stakeholders. It improves the ability of investor to compare investment on a global basis, so, and thus lower their risk of errors of judgment. It facilitates accounting and reporting for companies with a global operations and eliminates some costly requirements like reinstatement of financial statement. It has the potential to create a new standard of accountability and greater transparency provides value to all market participants, including regulators. It reduces operational challenges for accounting firms and focuses their values and expertise around an increasingly unified set of standards. It creates an unpredictable opportunity for standard setters and other stakeholders to improve the reporting model, and for the companies with joint listing in both domestic foreign country, the convergence is very much significant. Then International Accounting Standard Board IASB, with a view of achieving the objective of setting global standards, the London-based group, namely the IASC, that is International Accounting Standards Committee, responsible for developing international accounting standards, those are IAS, was established in June 1973, and it is presently known as International Accounting Standard Board, that is IASB. The IASC companies comprises the uh, professional accountancy bodies of over 75 countries, including the ICAI. Primarily, Primarily, ISC was established in the public interest to formulate and publish IAS to be followed in the preparation and presentation of financial statements. IAS were issued to promote acceptance and observance observance of IAS worldwide. The members of IISC undertook a responsibility to support the standards developed by IISC and to propagate those standards in their respective countries. Between 1973 and 2001, the IISC released IAS. Between 1997 and 1999, IISC restructured their organization, uh, which resulted in formation of ISB, an International Accounting Standard Board. These changes came into effect on 1st April 2001. Subsequently, ISB issued statements about current and future standards. ISB publishes its standards in a series of pronouncements called International Financial Reporting Standards for the IFRS. However, ISB has not rejected the standards issued by ISC. Those pronouncements continues to be designated as International Accounting Standard (IAS). The standards issued by ISC till 31st March 2001 are known as IAS, and the standards issued by ISB since 1st April 2001 are known as IFRS. Okay. Now, International Financial Reporting Standards IFRS as a global standard. The term IFRS comprises. First one is IS issued by the ISC and adopted by ISB. Then IFRS issued by ISB. Then interpretation on IAS and IFRS issued by IFRS Interpretation Committee. Then interpretation on IAS issued by SIC. Okay. So IFRS issued by ISB. Then IAS issued by IASC. Then interpretation issued by Standard Interpretation Committee. The SIC, and interpretation issued by IFRS Interpretation Committee of ISB called IFRIC, International Financial Reporting Standard Interpretation Committee. IFRS are considered as a principle-based set of standards. In fact, they establish broad rules rather than dictating specific treatments. Every major nation is moving towards adopting them to some extent. Large number of authorities permits public companies to use IFRS for stock exchange listing purposes. And in addition, banks, insurance companies, and stock exchanges may use them for their statutory requires reports. So over the next few years, number of companies will adopt the international standards. These requirements will affect thousands of enterprises, including their subsidiaries, equity investors, and joint venture partners. The increased use of IFRS is not limited to public companies listing requirement or statutory reporting. Many lenders and regulatory and government bodies are looking to IFRS to fulfill local financial reporting obligations related to the financing and licensing. Becoming IFRS compliant. Any country can become IFRS compliant either by adoption process or by convergence process. IFRS compliant, Technique 1 by adoption, Technique 2 by convergence. Technique 1 adoption process. Adoption would mean that the country sets a specific timetable when specific entities would be required to use IFRS as issued by the IASB. Technique 2 convergence process. Convergence means that the country will develop high quality compatible accounting standards, and there would be an alignment of the standards of the different standard sectors with certain rate of compromise by adopting the requirements of the standards either fully or partially. Indians are almost similar to IFRS, but with a few carve-outs so as to make them suitable for Indian environment. Convergence with IFRS will result in the following benefits. It improves investor confidence across the world with transparency and comparability, improves the inter-unit or inter-firm or inter-industry comparison. Group consolidation will be easy with same standard by all companies in the group irrespective of the global location. Acceptability of financial statement by the stock exchanges across the globe, which will facilitate listing of Indian companies to international stock exchanges. So when you say what are the benefits of becoming IFRS compliant is a cross-border flow of money, listing of companies of at global stock exchange, comparability of financial statement, greater transparency, low risk of error, and helps investor in decision making. What are the car outs and car ins? India's the government of India, in consultation with the ICI, decided to converge and not to adopt IFRS issued by the ISB. The decision of convergence rather than adoption was taken after the detailed analysis of IFRS requirements and extensive discussion with various stakeholders. Accordingly, while formulating India's efforts have been made to keep these standards as far as possible in line with the corresponding IAS or IFRS, and departures have been made where considered absolutely essential. These changes have been made considering various factors such as terminology differences, removal of options in accounting principle and practices, and difference in economic environment. Terminology differences, for example, various terminologies related changes have been made to make it consistent with the terminology used in law. For example, statement of profit and loss statement in place of statement of comprehensive income, and balance sheet in place of statement of financial position. Removal of options in accordance in accounting principle and practices. Removal of options in accounting principles and practices in India vis-a-vis IFRS have been made uh, to maintain consistency uh, and comparability of financial statements to be prepared by following Indias. However, these changes will not result into carve-outs. Difference in economic environment. Certain changes have been made considering the economic environment of the country, which is different as compared to the economic environment presumed to be existence by IFRS. These differences are due to the differences in economic conditions prevailing in India. These differences, which are in this deviation to the accounting principles and practices stated by IFRS, are commonly known as carve-outs. Now, additional guidance given in India's over and above what is given in IFRS is termed as carve-in. Now, formulation of India's departures resulting into carve-outs, not resulting into carve-outs, deviation from the accounting principles stated in IFRS, and not resulting into carve-outs, removal of optional in accounting principles and practices in India vis-a-vis IFRS. Convergence to IFRS in India. In the scenario of globalization, India cannot isolate itself from the accounting developments taking place worldwide. In India, so far as the ICI, NAFTA, and various regulators such as SEBI, Reserve Bank of India, are concerned, the aim to comply with the IFRS to the extent possible with the objective to formulate sound and financial reporting standards for the purpose of preparing globally acceptable financial statements The ICI being a member of the International Federation of Accounting Accountants, IPAC, that considered the IFRS tried to integrate them to the extent possible in the light of laws, custom practices, and business environment prevailing in India. Due to the recent stream of the overseas acquisition by Indian companies, there is a need for adoption of high quality standards to convince foreign enterprises about the financial standing, as also the disclosure and governance standards of Indian acquirers. In India, the ICI has worked towards convergence of global accounting standards by considering the application of IFRS in Indian corporate environment. Recognizing the growing need of full convergence of India's with IFRS, ICI constituted a task force to examine various issues involved. Full convergence involves adoption of IFRS in the same form as that issued by the ISB. For convergence of India's with IFRS, the ASB in consultation with the MCA decided that there will be no two separate sets of accounting standards. For example, India's converge with IFRS standards, which are being converged by eliminating the differences of the India's and with the IFRS and existing notified years. So ICI convergence to IFRS, not adoption. Applications of convergence to IFRS, not adoption. Application of IFRS in India, considering legal and other conditions prevailing in India. Then deviation from corresponding IFRS if required. The decision to have two set of accounting standards. One is India's and another one is existing, that the US accounting standard. And what are the Indian accounting standards? India's are IFRS converged standards issued by the central government of India under the supervision and control of ESP of ICI and in consultation with NAPA. NAPA recommends these standards to the MCA. MCA has to spell out the accounting standards applicable for companies in India. India's are named and numbered in the same way as the corresponding IS. However, for India's corresponding to IFRS, one need to add 100 to the IFRS number. For example, IFRS 1 corresponding to India's 101. So, Indian accounting standards, globalization and liberalization, transparency of financial statement, then comparability of financial statement, enhanced disclosure requirement, history of IFRS converge Indian accounting standards, India's first step towards IFRS. The ICI being the accounting standard setting body in India way back in 2006 initiated initiated the process of moving towards the IFRS issued by the ISP with a view to enhance the acceptability and transparency of the financial information communicated by the Indian corporates through their financial statement. This move towards IFRS was subsequently accepted by the Government of India. Government of India commit, commitment to IFRS Converge India's as per the original roadmap for implementation of IFRS Converge India's issued by the Government of India. Initially, India's were expected to be implemented from the year 2011. However, keeping in view the fact that certain issues, including tax issues, were still to be addressed, and the Ministry of Corporate Affairs decided to postpone the date of implementation of India's. In July 2014, the Finance Minister of India at that time, late Sri Arun Jaitley ji, in his budget speech announced an urgency to converge the existing accounting standards with the IFRS through the adoption of the Indias by Indian companies. Pursuant to the above announcement, various steps have been taken to facilitate the implementation of IFRS converged Indias. Moving in this direction, the MCA issued the company's Indian Accounting Standards Rules 2015 wide notification dated February 16, 2015, covering the revised roadmap of the implementation of India's for companies other than banking companies, insurance companies, and NBFCs and India's. As per the notifications, India's converge with IFRS were required to be implemented on voluntary basis from 1st April 2025 and mandatory for 1st April 2016. Separate roadmaps were prescribed by implementation of India's to banking, insurance companies, and NBFCs. So this are the comparison that we are going to go through. Okay, then we will see roadmap for implementation of Indian accounting standards, a snapshot like for companies other than bank, NBFCs, insurance companies, bank, NBFCs, and insurance companies, phase one, 1st April 2025, or thereafter with comparatives, voluntary basis for any companies on voluntary basis, they have uh, phase out, phase the India's in Indian economy and foreign company, Indian companies other than banks, NBFCs, and insurance companies, and its holding and subsidiary and joint venture or associate company. But 1st April 2016, they have mandatory basis, they have applicability on mandatory basis. For example, for which companies listed in the or in process of listing on stock exchange in India or outside India having net worth more than 500 uh, net worth 500 or more than 500 crore. Then unlisted companies having net worth of uh, INR 500 crore or more, and parent subsidiary, associate or joint venture of the above. Then in phase two, 1st April 2017, 1 year only, mandatory basis for all companies which are listed or in process of listing on stock exchange in India or outside India, not covered in phase one, other than companies listed on SME exchange. So here all listed companies have been commented, have been comes under the come under the India's. Then unlisted companies having net worth of INR 250 crore or more, but less than INR 500 crore because because here they are above 500 crore and above 500 crore covered in the this section. So above 250 and above 250 crore is covered here maybe from 1st April 2017. Then parents, affiliate, associate, and JV of the above. Special points to consider. Companies listed on SME exchange are not required to apply in years, such as companies shall continue to apply existing years unless they do otherwise. Okay. Then once Indians are applicable, an entity shall be required to follow the Indians for all subsequent financial statements, and there is no looking back once the Indians are adopted by companies. Companies not covered by the above roadmap shall continue to apply accounting standard notified in company accounting standard rules 2006 or non-banking financial companies that the NBFC scheduled commercial bank excluding RRBs, insurance and insurance companies. Phase one from 1st April 2018 with comparative NBFCs where the listed and unlisted having the net worth of more than 500 crores, 500 crore and more than 500 crores, holding subsidiary JV and associate companies of the above NBFCs other than those already covered under the corporate roadmap shall also apply from said date. Phase two from 1st April 2019 with comparative NBFCs whose equity and or debt securities are listed or are in the process of listing on any stock exchange in India or outside India having net worth less than 500 crores. So here they have got all listed or unlisted NBFCs. Okay. Then NBFCs that are but from 2018 and 2019. Okay. Then NBFCs that are unlisted having net worth more than 250 or more than 250 crores and less than 500 crores. So NBFCs they're unlisted NBFCs have been covered. Okay. Then holding subsidiary and JV associates companies of the above companies other than those already covered under the corporate roadmap shall also apply India's from the said date and applicable to both consolidated and standalone or individual financial statement. NBFC have net worth below 250 crores or not covered under the above provision shall continue to apply accounting standards specifying in Annexure Companies Accounting Standard Rule 2006. Adoption of India's is allowed only when required as per the roadmap. Voluntary adoption of India's is not allowed. Remember. Okay. Now, scheduled commercial banks excluding RRBs. Scheduled commercial banks, yes, SCBs, excluding RRBs, were initially required to implement India's from 1st April 2018. However, RBI, yeah, white press release dated on 5th April 2008 deferred the implementation of India's by 1 year, so that to be effective from 1st April 2019 instead of 1st April 2018. Further, the RBI, through notification dated on 22nd March 2019, deferred the India's implementation till further notice. Urban cooperative banks, UCBs, and regional rural banks (RRBs) are not required to comply with India's. Then insurance companies, insurers and insurance companies, MCA had outlined the roadmap for the implementation of India's by insurance companies from 1st April 2018. IRDA had deferred the implementation of India's in the insurance sector in India for a period of 2 years, whereby the effective date was deferred to 1st April 2020. Then IRD the White Circular Notice 21st January 2020 had deferred the implementation of India's in the insurance sector till further notice. So IRDA and RBI rejected India's implementation. Summary. This is the summary. We summarize whatever we have learned in whatever we have learned in this chapter. Okay, summary. The accounting standard aim to improving the quality of financial reporting by promoting comparability, consistency, transparency in the interest of users of financial statement. The ICA has so far issued 29 accounting standards. However, AS6 on depreciation accounting was written on the revision of AS10 property, plant equipment, and AS8 accounting for research and development has been withdrawn consequent to the issuance of AS26 on intangible asset. Thus, there are 27 accounting standards at present. In the scenario of globalization, India cannot isolate itself from the developments taking place worldwide. In India, so far as the ICI and the government authorities and various regulators such as SEBI, RBI are concerned, the aim has always been to comply with the IFRS to the extent possible with the objective of formulating sound financial reporting standards. India's are IFRS converge standards and issued by the central government of India under the supervision and control of ESG of ICI and in consultation with NAPA. As per the MCA notification dated on 16 February 2015, India's converge with IFRS shall be implemented on a voluntary basis from 1st April 2015 and mandatorily from 1st April 2016. Separate roadmaps have been prescribed for the implementation of NDS in banking companies, insurance companies, and NBFCs. Now, accounting standards for non-corporate entities in India are issued by non-corporate ICAI. Then accounting standards harmonize the accounting policy and eliminate the non-comparability of financial statement, right? Improve the reliability of financial statement, right? So both A and B manipulate. No. If the it is essential to standardize the accounting principle and policies in order to ensure standardize the transparency and comparability. All the which committee is responsible for approval of accounting standards and the modification for the purpose of applicability to companies. Modification for the purpose of applicability of companies MCA. Global standards facilitate cross-border crop money, all the explain the objective of accounting standard in brief and state the advantages of accounting standard briefly explain. So we'll see one problem. It's the accounting standard objective and Advantage of uh, advantages of setting accounting standards. So we'll go to six. And the problem, what the answer there is accounting standard are the written policy documents issued by the government relating to the various aspects of measurement, treatment, presentation, and disclosure of accounting transaction and event. Following are the objectives of accounting standard. Accounting standard harmonize the diverse accounting policies. Then accounting standard facilitate the preparation of financial statement and make them comparable, harmonization, comparability, and the practices followed by the different companies in India. So it is harmonization and then comparability and facilitation for preparation and presentation of financial statement. The accounting standard give a sense and faith and reliability to the user. Sense of faith and reliability to the user. Then the main advantage of setting accounting standards are as follows. Accounting standard makes financial statements of different companies comparable, which helps the investor to in decision making. Comparable in helps investor in decision making. Then accounting standard prevent misleading of accounting treatment, misleading accounting treatment. Then prevent manipulation of data by the management. So these are the advantages of setting accounting standards. Okay. Now seventh one is seventh one. Brief explain the process of issuance of Indian accounting standard. Indian accounting standards. Yes. We need. Yes. Okay, then explain the significance and evolutions of IFRS as a global standards and what do you mean by carve-outs and carve-in in India? Explain. Now, here, seventh one. Due to the recent stream of overseas acquisition by Indian companies, there is a need of adoption of high quality standard to convince foreign enterprises about the financial standing as also the disclosure and governance standards of the Indian acquirers. The government of India is in consultation with ICI and decided to converge and not to adopt IFRS issued by the ISB. The decision of convergence rather than adoption was taken after the detailed analysis of IFRS requirements and extensive discussion with the various stakeholders. The ICA has worked towards convergence of global accounting standards by considering the application of IFRS in Indian corporate environment, recognizing the growing need of full convergence of India's with IFRS. ICA constituted a task force to examine various issues involved. India's are issued by the central government of India under the supervision of supervision and control of ESG or ICA and in consultation is NAFTA. NAFTA recommend this standards to NCA and NCA has uh, spell out the accounting standards applicable for companies in India. Then uh, the section that is explain the significance of emergence of IFRS as a global standard. Global standards facilitate cross-border flow of money, global listing in different bourses and comparability of financial statement. Global standards improve the ability of investor to compare investments on a global basis and thus lower the risk of errors of judgment, which facilitate accounting and reporting for companies with global operations and eliminate some costly requirements, say restatement of financial statement. Then we'll see what do you mean by carve-outs and carve-ins in India? So certain changes have been made in India considering the economic environment of the country, which is different as compared to the economic environment presented to presumed to be in existence by IFRS. These differences are due to the differences in economic conditions prevailing in India. These differences, which are in deviation to the accounting principles and practices stated in the IFRS, are commonly known as outs and additional guidance given in India's over and above what is given in IFRS is termed as ins. Okay, so we have covered the first chapter, introduction to accounting standards. Then now we will in the second lecture, second webinar, we will cover framework for preparation and presentation of financial statement. Okay, thank you. Bye now.